We're super excited to have a chance to talk about what's going on in the ecosystem. And we have four amazing panelists here that are going to fill you in on how they're thinking about things. But I thought it would be fun to maybe start with something a little different. So we're going to start with a little bit of a quiz. So if the lights can get brought up a little bit, and then we'll go to the slides. And so a lot of you guys know me. I'm with Silicon Valley Bank. I've been putting together a report for the last 10 years plus, talking about what's going on in the venture ecosystem. So I thought as a part of teeing up the conversation, we just do a quick little quiz. So it's a quiz around what's going on in the market. So we'll start with question number 1. So if you think about $67 billion were raised by US-based funds to be invested into venture-backed healthcare since 2020, so the last 3 years. What percentage is likely to be invested in medtech versus health tech, DX tools, pharma? And just think about medtech as implantables, surgical equipment, imaging if there's a piece of equipment, and then also sort of non-invasive monitoring. So that's kind of our medtech definition. So is it 3%, 7%, 10%, or 18%? Anyone think it's, so show of hands, 3%, 7%, 10%, 18%? Great. Answer is 7%. So about $5 billion in dedicated venture funds have been raised since 2020 to invest in medtech. And if you think about it, that ends up about 20% of all dollars that are actually invested in medtech over the last 3 years. So just the takeaway is there's a lot of funds outside of your traditional venture folks that are investing in the medtech companies. Second question. So in the US, 2021, $6.8 billion invested into medtech venture-backed companies, which beat the record of $5.8 billion in 2020. How much was invested in US venture-backed medtech companies in 2022? So A, 5.5 billion, B, 6 billion, C, 6.6 billion, D, 7.1 billion. It's pretty evenly distributed. Answer, 7.1 billion, a record number of dollars invested into medtech sector in 2022. And I think the context here is, yes, it's a small amount if you compare it to biotech, but what we've all seen in health tech or healthcare overall, especially in medtech, like steady Eddie is what medtech has been over the last few years. But even in a down year by most people's standards, there's actually more dollars invested in medtech in 2022. So 2 more quick questions. So we track step-ups. So you look at the post-money of the previous round, and you look at the pre-money of the next round. That's sort of the step-up. What were the step-ups of the ones where we found valuation information by PitchBook, which is 103 data points in 2022? Is it 0.8x, 1.5x, a few, 2x, a couple, 2.5x, 2 very folks who are looking to be optimistic. The answer is 1.5x, which I think is really interesting. We're still seeing step-ups. I do think, is interesting, even the bigger financings that we saw, where there were over $70 million in terms of the size of the financing, that median step-up was 1.9x. So some of these good companies are getting good step-ups. But I will say, what do we think things are going to look like down the road? I still think that that's looking at the top 20% of companies. The top 20% of companies were able to finance last year with a new investor coming in. And we'll talk more about what that means going forward. And so the last question, $100 million private venture-backed financings. There were 9 in 2020. There were 11 in 2021. How many were there in 2022? 8? A few? 11? 14? A lot more there. 19? A couple optimistic folks. Answer is 19. Unbelievable. $100 million financings in the US and Europe in venture-backed companies. And I just think that that's really an interesting thing we'll get into on our questions here. But we're seeing a lot of really late-stage folks coming into Device supporting commercialization stories. So with that being the setting the stage, we can take the slides back off. And what I'd like to do is sort of go through our panelists and have them just take a quick moment to introduce themselves and tell what their focus is on the medtech side. And we'll start with Kyle. We'll move our way down.
So I'm Kyle. I'm with MVM Partners. We've been around a long time. We focus on commercial stage medtech investing, among other areas of healthcare.
Hi, I'm Lou. I'm the founder and managing partner of Fusion Fund. We're a VC firm based in Silicon Valley, mainly focused on, in general, healthcare tech and the med tech. And we've been doing early stage investments since 2015.
Greg Madden, SV Health Investors. I'm a managing partner there. We're a 30-year-old firm that has invested over $3 billion across hundreds of companies since inception. I've been at the firm a little over 20 years, have focused most of my time at SV on medtech, and what I'm excited about with what we do with medtech is that we have a few vehicles that allow us to invest everything from Series A through growth stage commercialization rounds and even buyouts for the most mature companies.
Juan-Pablo, partner with Action Potential Venture Capital, which is a stage agnostic medical device fund focused predominantly historically on neuromodulation, bioelectronic medicines. We invest off of GSK's balance sheet, and more recently have broadened our mandate to include some drug device combinations, diagnostic imaging, AI, and precision diagnostics. But we're a rather small team, 3 people, 11 portfolio companies, and we're on all the boards, very involved with our companies.
Great, thanks everyone for the intro. I think I want to dive in on talking about what 2023 is going to look like on the financing side. What we've noticed is what we call a Series A cliff, where if you go back, the last 2 years, there's been a lot of Series A activity in medtech with a corresponding decrease in the number of Series Bs that are being done. So you would assume that the Bs were being done, but what we're seeing is a lot of insider support and sort of pushing these companies to move forward, which sets the stage for 2023 for like the next financing and what that is going to look like. And question to you is, how are people thinking about milestones and milestone achievement that unlocks the next round in 2023? Do you think insiders are going to be continuing to sort of foot the bill here? And is it going to be traditional venture that comes in? How are you thinking about 2023 financing? And we'll start with you, Greg. Maybe you can lead us off. Sure.
So I think it's, given the change in the economic environment, I think it's inevitable that insiders are going to have to carry companies further, whether they do an inside-led Series B or bridge financing. There are other pockets of capital available for companies in the Series A and Series B stage. Corporate venture capital, which I know, John, you cover in your data as well. And we've seen in prior downturns that corporate venture capital has helped fill a gap when fundraising has slowed for traditional venture capital firms. I'm not convinced, based on what I'm seeing right now, that will emerge in this trend, only because, or in this environment, only because we've really seen a dramatic decrease in corporate venture capital dollars, particularly for Series A, Series B companies in the last, really since the onset of COVID. I was surprised also at your data that you put up about 80 or 70 or 80% of the capital coming from other sources than non-traditional medtech. If anyone in this room knows who those people are, please see me immediately after the panel. But in all seriousness, we've seen this movie before. What happens in environments like this are that the tourists flee from the segment. You see VCs, traditional VCs like us, have been dedicated to the space for 3 decades, batten down the hatches, increase reserves for existing portfolio companies, and you see later stage valuations come down. And when that happens, all of a sudden it's much more attractive for me to look at a de-risked Series B or Series C asset as compared to the higher risk Series A, because the valuations comes down and it gets closer to Series A-like valuations. So I expect we'll see that again. I think that will continue to be the detriment of Series A's. I do believe Series B's will get done. It'll be insiders. I think there will be some money that flowed into areas like non-invasive monitoring that may get reallocated to other traditional segments. So stuff that verged on digital health may move into orthopedics, cardiovascular, other other segments. And I would say the final thing that I'm, the optimist in me wants to see is that for years we saw a migration of capital outside of medtech, probably to the benefit of biotech. And the data that John showed of 7% of the money flowing to medtech, for the first at least half, if not 3/4 of my career, that was about 20%. And with the shine coming off of biotech, I am cautiously optimistic that there'll be a rotation back towards medtech, particularly in those middle Series B stage type rounds.
Yeah, great. I'd love to hear other folks' perspective, and just the idea also of, as the insider support of doing inside rounds grows, that obviously diminishes the amount you have reserved for support of that company. But does it also affect the number of deals that you're going to do going forward? Just would love to hear how folks are thinking about where the market's going to go and where we go from here. And I'll let anyone who wants to jump in.
Well, we have a bit of a different dynamic in the sense that we have sort of more of an evergreen fund, and so reserve management has more flexibility. But that said, we're in a variety of companies, and we manage our portfolio as if we didn't have an evergreen fund for, and we do, try and be judicious around how much we cover as insiders, bridging companies through, my perspective is to bridge a company to avoid a down round is not the reason to bridge a company. I think bridging companies to meaningful milestones that really de-risk the asset and attract all types of new investors is why you do this. You do see some insider-led rounds where the hope is to just hang on to a valuation, and more often than not, you're better off taking your medicine, resetting price, making it easy for other investors, new investors, to approach the company. And it's not a fun thing. Most investors don't get into venture to sort of walk around giving down rounds to everybody. It's not, you're not usually everybody's best friend doing that. And so if you have a sober view on your own valuation and you've been priced up in a very hot environment, either repricing the company yourselves as insiders if you're going to go through that process, or signaling very clearly, to new investors, especially in the last, the Fed just raised interest rates today. It's not getting prettier quick. So do yourself a favor, give yourself as many pitches, shots on goal with new investors, and tell people, listen, you're open to price resets if that's what the market is saying. And so that's kind of our approach.
Yeah, and actually that sort of dovetails into the next question I wanted to ask, and maybe Kyle, you can lead this off. When you do talk about valuations, I think we are starting to see folks understand that, one, I heard this in another panel, that valuation is what someone values you at, and that while that's trite, I think the idea is trying to disassemble that from you and your company and all the positive milestones you may have hit, because you may have hit everything that you set out to achieve, yet still the valuation discussion may be something that you're not liking. And so, Kyle, when you think about valuation, you think about where things are going to go. Obviously, when you look at public market comps, there's a huge difference in where we were 2 years ago. How do you think about that in the market as an investor? And then how do you talk about that with your management team in terms of, having them understand that how important new money is to come in, and that at the sacrifice of valuation is sometimes maybe the right way to go?
Yeah, I think it's really important for everyone to level set and just understand, at least from our side of the table, how valuations are set, because a lot of times it feels like they just come from nowhere or that they're arbitrary. I think most people sitting up here and most people in the industry actually take a much more nuanced approach. And just to kind of walk you through it, most of us think about all the different scenarios that could play out for a company. So, in some scenarios, companies fail. They don't hit a regulatory milestone. They don't get financed. So that's one extreme, right? The company ultimately fails. On the other side, there are cases that look even better than management's plan, right? There are cases where things go better than everyone expects. And then in between, there's a whole variety of scenarios that play out with different degrees of probabilities. And so what we do is we try to model all of those major scenarios and then assign probabilities across them based on the likelihood that we think they are to occur. And then when we do that, each of those scenarios in turn has an exit valuation attached to it. Those exit valuations are driven by what we think the revenue or EBITDA or whatever the marker is at the exit point, along with some sort of trading multiple or a cash flow analysis or something along those lines. And so there's a distribution of outcomes that we're considering at any given time, and the ultimate exit point, whether that's an IPO or a trade sale, is impacted by things like the public market multiples. And so to John's point around how does this all feed back into the process, I mean, at a very granular level, this is where it plays in, because as you think about those multiples that you're assigning to those different exit scenarios, that may color how you think about those. And so it definitely does have an impact. And my perception is that a lot of companies that have done Series A and are now looking to do a significant commercial round, my perception is that a lot of times people are surprised by the valuations that come out of these exercises. Because as has been said, a lot of progress can be made, a lot of important milestones, regulatory, clinical, et cetera. But a slightly different way to think about it using this framework of probability weighted distributions is that sitting where we sit, we now know that there's a whole segment of outcomes that is not likely to happen. Meaning, when you're pre-regulatory or when you don't have all your clinical data, there is a reasonable probability that once you get that approval, somebody buys you out immediately. Like if you are really important strategically to another entity, they may buy you at that point in time. Well, now that you're past that point, it's clear that that part of the distribution falls away. So that quick exit that requires very minimal capital is no longer on the table. And as a result, the distribution of outcomes changes, and in turn, that's what drives a change in valuation. And so for why people may have very different perspectives on valuation, it really just comes down to how all these different things are playing out in the background. And hopefully this makes it feel a bit less like a black box.
Yeah.
Yes, I could chime in there because that's a really frequent conversation we have with our founder about how to really look at valuation. Also because I was an entrepreneur turned investor. I was an entrepreneur myself, and also the whole team at Fusion, we all have entrepreneur experience. So one thing we always tell founder is valuation is an illusion. Valuation does not 100% reflect the value of your company. So the thing really matters to founder is the ownership, really. There's so many different ways. If you really achieve the milestone, if the company do well, the board investor definitely want to maintain certain ownership for the founder to give them incentives to continue to work harder on that. So sometimes when there's a fundraising difficulty, surviving is the most important thing. And as you said, getting new money in is important because that's a different type of market validation versus purely go to the same insider to raise money again. And when you have the money in, and regardless of the valuation, you have the dry powder to continue run and also grow. So that's the first thing. Another thing is really, you mentioned about the different dynamic right now in the market. Look at how to give valuation to the company. Good and bad, I think, especially growth stage investor, they really have this hard right line inside looking at commercial capability, which I know is a little bit unfair to medtech company because we need to go through clinical trial FDA approval. It's not easy as an enterprise SaaS company to quickly get revenue. But any indication at early stage, even just a pilot program, is a paid service contract with a potential customer, that would give stronger confidence for investor to put in bigger check in the growth stage. It's just the market dynamic is different now. But on the other side, based on your number, that's also actually what we saw in the market. There's dry powder in the market. It's more concentrated to the top company. So company who perform well still will be able to raise a lot of money, but it just the percentage in average will be much lower.
Mm-hmm. And then you have those conversations where, maybe Greg and Juan-Pablo, you guys have some gray in your beard like I do. How do you have those conversations with management during this time where you can leverage maybe the stories of folks in the past that have had those bumps along the road but end up having great outcomes? Do you find that it's hard, or do you find that in this sector people understand that, sometimes you have to make some sacrifices in the long run to make sure you have the right capitalization.
So in my experience, there's a couple things that happen. One is we priced the deal wrong, and that's a harder conversation than if either before us or after us, softer money came in and we all felt like we were stealing something with the valuation we had. And in those cases, I think the conversation is more about we need to think about this as a blended cost of capital over the life of the company versus this interim markdown that doesn't really mean anything. In cases where we have priced something wrong, it's typically because the company got off plan or we underestimated the risks and we ended up at a lower case scenario as Kyle was describing. In those situations, it's a shared responsibility. And what we usually tell our founders is similar to the advice we've heard from this group, which is the market is the market. It's a point in time. It doesn't devalue you or your technology, but it is the price at which capital is being invested today. And it's about selecting the right partner that can work constructively with us to get to the promised land. Then this interim markup. It's painful for everybody. And usually it's investors like us that get squeezed in the middle more than the management team, which if they're executing, typically get re-upped in some way through options, even though there's dilution to their founder stock.
Yeah, I'd only add that, I think I've seen some first-time founders or first-time CEOs maybe make the false assumption that if they're not seeing valuations they like after testing the market at a new round, that the insiders are just going to carry the round and we're going to need you guys to do this. And I think the more experienced entrepreneurs and CEOs know that that's, you may get that, you may have the discussion with your board and you may get that support, but it is far from a fair assumption to anticipate, because some of these rounds, of course, either are significant in size or dry up all the reserves that these investors have to protect their positions in the company long term. So, but more typically when we're seeing term sheets and that founders don't like, it's not like we're sitting there staring at 5 and 6 term sheets and going, let's take a low valuation. It's because you got one, if you're lucky, or you got one, maybe there'll be a second one, and people are saying, can you bridge us just a little longer? I need to talk to a few more investors, and optimistic. And I think, if founders aren't hearing that, and I know there are many in the room as well, but as I think you kind of alluded to in the way you asked the question, having them speak to more seasoned founders that have lived through a variety of cycles to hear how this could be in their best interest long term, just to keep the company alive. Lou, you said, right, survive.
Yeah.
The only thing I'd add to that, reflecting on it, is that I have seen companies and founders, not only for their own preservation, but out of respect for the people that put in the money early, to try and hang on to a post-money valuation, and they rip through 3/4 of our addressable market. And once someone says no, it's no. There's no going back, even if you say, oh, actually, we weren't serious about that valuation. We're willing to accept something lower. People have moved on. And so you have to be very careful how you have those conversations and be realistic about the expectation.
Great. This is really good advice. Really appreciate that. And maybe let's talk a little bit more about what I've seen out here, looking at a lot of the companies that presented at this conference over the last couple of days, is really the intersection of hardware and software and AI and sort of the digital aspect and what you guys see in medtech around that. And Lou, maybe you can lead us off in terms of how you're thinking about that. What's exciting now? Where do you think things are going to go? And what's the promise?
Yeah, I think you already mentioned one key word, which is digital. We talk about the whole trend here is the digital transformation across all different industry, and the industry really want the digitalization to be done the most is the healthcare sector in general. So we're seeing lots of the traditional medtech companies start to implement a digital platform, which is actually really valuable because on one side, there's lots of data to be dig out from the data to provide personalized healthcare product and services. And on the other side, we also mentioned that in terms of the potential exit value for a medtech company, merger acquisition sometimes is limited. With a digital platform, you'll be able to bundle different type of medtech company, make a portfolio. So the potential exit value could be over $1 billion or even become an independent IPO candidates. So I think that's all the opportunity brought in by the digital to the medtech in general. So for us, since last year, we've been investing in digital like diagnostic and diagnostic for a long time. And since past couple of years, we're more focused on digital diagnostic, especially for medtech company focused on cancer and also mental disease. That's a really interesting area, and also lots of data could be leveraged. Lots of new technology could help us find out better solution. Another sector is digital therapeutics. I think there's lots of things going on in digital therapeutics, and it's very promising. FDA is catching up. Insurance companies working on the potential reimbursement side. And also lots of the technology, hardware side, software side is ready. So that's another area we've been looking at. And in general, you also mentioned another keyword is AI in device. I know generative AI being so hot in the past couple months, and especially generative AI application for healthcare. That's a big opportunity. So we already have company focused on medical imaging, integrate generative AI, very good result. Generative AI solution for platform for life science, and also for other different aspects in the medtech sector. So that's actually the upcoming trend.
Interesting. Anyone else want to talk a little bit about what they're seeing?
I guess just a general observation or a couple. One is that AI is definitely having a profound impact in terms of the opportunities that are getting created across all these different subsectors. If you're a company that's operating in that space, just one thing to really reflect on are barriers to entry. So we've taken a look at a lot of promising companies, and unlike medtech and unlike some other areas, a lot of the AI-type solutions are not able to get intellectual property that's meaningful. And what we've seen in a couple different segments at this point is basically rapid commoditization across those. So, things that have been very innovative, delivered very significant clinical impact and a lot of value for a lot of people, but not being able to actually capture that value due to a lack of barriers to entry. So if you're involved with that industry or you're working on a solution related to it, I think step one is to think very, very carefully about how you're going to protect your solution, because my general observation is that creating a new algorithm is something that a lot of people can do, and they can do it quickly and get it through the FDA relatively quickly. So thinking more creatively about how to create those barriers is important.
Yeah, I think regulatory strategy, maybe even reimbursement strategy, is a possible barrier to entry in AI. And we've not done a lot. We've done one actually in oncology more recently. But the ability to get paid like a medical device, software as a medical device, also is a bit more of a, even though it's a new space and a new era, there's a little bit more predictability perhaps about what that business model looks like, though still many levers to pull. And I think to your point, Lou, earlier, the early traction helps validate this for investors. The other business model that we see occasionally, and I think we're always intrigued when we look at it in digital health, and is our Trojan horse type business models where you're selling one thing to the hospital or to a customer and serving a real need and generating revenue from that perhaps, but aggregating a lot of data and finding a way to sell future products that may not be the most obvious initial business model.
Interesting. Maybe one more question, then I want to turn to the audience in case there's some questions there. But one of the slides I showed was $1,900 million plus financings in venture-backed device in 2022. And when you look at who the new investors that are coming in, you're seeing late-stage growth investors, you're seeing crossovers, you're seeing hedge funds, you're seeing crossovers that traditionally do biotech coming into device and funding a lot of these folks large commercialization rounds. And I guess the question is, do you see this as transitory cash? And what does that mean for the companies that do get funded, that right now, it's all fair to say that the IPO window is fairly closed, if not firmly shut right now. What does that pose for those companies, and what does it pose for the companies that are looking to raise those $100 million rounds in 2023? Do you think the capital is still there? What's the prognosis for sort of late-stage device for 2023? Maybe Juan-Pablo, you want to kick it off? I think you've had some bigger financings of some of your portfolio.
Yeah, so we've had a few in the last few years, attracting groups like many of the logos on the slide you shared with Fidelity and T. Rowe and BlackRock and a variety of others, and Red Mile being actually an RA Capital being sort of more healthcare-centric groups. I think that, to take a page out of your book, because I've heard you say this before, the high-quality companies will probably still be able to attract those financings and those investors, but they are being squeezed, no question, and it is going to be harder, and the same valuation discussions are happening there. I think, Greg, you mentioned earlier, maybe later stage deals start to look more attractive, and so there's also a mentality from some investors, maybe not these crossover types, but that if I can invest in some early stage things now, I have a little bit longer time before these companies have to be exposed to the public market dynamics or the crossover stage dynamics. So we'll see how that plays out, but I do think you're probably better off if these firms have already invested in your company, because they're more likely to follow on those dollars if they still believe. I think it'll probably be harder to attract them, at first pass. And certainly if they think that many of them say you need to IPO within 12 months or so for us to be interested, and that's a hard sell right now. So.
Yeah, the only other thing I'd add is that I think the $100 million plus rounds was more a symptom of the market's valuing top-line growth. You could raise $100 million, you could have 20% gross margin, and people are throwing money at you. That's not happening anymore. Those days are over. And I do think we're going to see more rational financing plans for later stage companies focused on getting closer to profitability, showing high gross margins. Investors will become more selective looking for those things. And as a result, I don't think you'll see $100 million rounds. I think you'll see late commercial rounds be more in the $50 million range, because they're funding businesses that are fundamentally profitable, and the market's rewarded businesses for a long time that could grow 50 to 100% a year, but were fundamentally unprofitable.
And maybe anyone else who wants to jump in on that?
Yeah, sure. Probably provide some silver lining, like good news for the founder. We have this Axel network. We have lots of this global 1,000 company CTO work with us. Recently, we all heard most of them talking with us, saying that there are lots of discussion on the board level about increasing their budget to the CTO office. Then the CTO could have bigger budget either to give contract or direct investing into the startup companies or even do merge acquisition. I think this is a relatively new topic because all the companies realize, okay, now it's really the booming of the tech trend right now. Meanwhile, because of the financial market, the valuation will be more reasonable for them to come into the market. So might become a new source of capital for a grow late stage company to consider. And also, I do think the reason you also mentioned that there's some relative new money from biotech came into the medtech. I think one push was also related to digital transformation, because how to collect the data. Cal also mentioned that, okay, what is a barrier for even AI in healthcare company? AI algorithm, generative AI, essentially gonna be similar between different company. Unique data library is a key differentiation. And what is the entrance of the data? It's actually device, it's actually the hardware layer. How to control the entrance of data, that's also one critical question for lots of investors and the company to think about. So I know it's gonna be hard. This year gonna be hard in general for all the founders to raise money, but I think there's some good momentum happening right now.
Great.
Maybe I'll just tag on one quick thing, and I think this is more for the audience than to hear myself speak, so I'll add on here. But I would say one thing we're seeing where valuations may be tricky is investors that are going to put in bigger checks. And you saw Deerfield on stage a moment ago and others. There are some financings that may help bridge this valuation pressure, but still get you to milestones. If you can find a later stage investor that does structured financing with tranches, you could very well, and we're seeing some of our companies entertain these, where it's a valuation you can get comfortable with, and it gets you to a much later stage milestone than you were even initially considering fundraising for. You just, to be able to talk about commercial and launch or FDA approval versus just talking about first in human experience can change the equation on what valuation and post money looks like, and get people to the table in a way that, and that's not easy, but if you have that angle, at least don't limit yourself to just one universe of investor when you're talking.
Right, and let's not forget how much capital has been raised by traditional venture folks over the last couple of years, and that needs to get deployed. So we only have a couple of minutes, but I was wondering if there's some burning questions from the audience. Yeah, actually, I'm just going to hand you the mic.
Yeah, I was just curious where you come out on the viability of a SPAC, de-SPAC transaction as a possible source of capital or liquidity event, public listing, all the above, if that's something that you ever entertain as a potential outcome for any of your portfolio companies.
So I've got a little bit of experience in this area over the years. I would say SPAC, or that approach to going public, I think came about because the barriers and the hurdles to get public in a traditional sense are probably too high, and I think the SEC probably needs to spend some time there. I think there's two different types of SPACs. There's a SPAC with committed capital, and it's a vehicle for turning the company public and building for the long term. And then there's SPACs to raise capital from retail investors. And those are the SPACs that aren't happening and are likely to come back anytime in the near future because retail investors are not coming into this space any longer. And there was a real disconnect between the incentives that the SPAC sponsors were reaping versus the pricing that the retail investors were funding. But I do think, as a structure, it is not a bad vehicle, but the capital needs to be committed up front and be secured versus hoping that somehow retail investors it'll be a way to get cheap money from retail investors.
Plus 100% redemption.
So,
right.
So SPAC
and if
plus
your money's
PIPE.
committed up front, the investors that have committed the capital aren't likely to redeem.
Okay, we are right at time. One super quick question. Last one.
Hey, Sharif Tarman, CEO at Cognoa. I was going to piggyback off the SPAC conversation, which is, if I really do postmortem on some of the SPAC stuff, is it the ones that failed, was it they overvalued themselves, they didn't have enough revenue, that they went prematurely to SPAC, and maybe that's why they should have waited to do IPO? Would love to hear your thoughts.
All that. Yeah,
Yes.
Yeah, I just say you really got to think about everyone's incentives that are involved with these SPACs. You've got the SPAC founder, sponsor. You then got the people that are putting their money into the SPAC that could redeem or not based on the quality of the assets that's found. And then you've got the bankers, and the bankers are, of course, telling you that the SPAC's going to go through with 100% certainty and that your company's only going to go up from there. All of these people have very different incentives, and so it's important to always keep each of those distinct incentives in mind when working through whether or not it truly makes sense for your company. For most of the companies in this building today, I think SPACs don't make a ton of sense because at the revenue stages of most of the companies that are at LSI, you're likely to have a relatively low valuation by public market standards, meaning that if you're below 500 million in valuation, you won't get top analyst coverage. You're likely to have very low liquidity, which will then make it very difficult for you to increase your share price and to raise capital in the future if you need to. So the grass isn't always greener in the public markets, and I would be a little bit weary of anyone who tells you otherwise.
Thanks, Kyle. And that's all the time we have for today. If you can just join me in thanking our panelists who did a fantastic job. Thank you, guys.